First show of the new year, 2026. We're working through some of the trends that we think will have major impact in 2026. And then we're going to finish it up with our fearless forecast. So welcome on into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top financial planning podcast out there on the World Wide Web. To learn more about us and what we do on a daily basis by helping people to make better decisions with their money, check out our website at nelsonfinancialplanning.com. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. So trends for 2026, we talked about the continuation of the AI trend from last year. We think that's going to continue to be a major player in driving corporate earnings. Corporate earnings, in fact, expected to grow by 14% this year, 2026, versus 12% last year, 2025. We do think that you're going to see that in a much broader range of companies rather than just the concentration that has been occurring among those predominantly AI names like NVIDIA and Microsoft and Amazon and Google. We do think that you're going to see that much more broadly in the markets. Number two that we were talking about is the tax cut. Obviously here, a lot of that tax bill went to continuing the lower tax rates. But there will certainly be an impact, particularly if you're below certain income levels, where you could certainly see some extra money in your pocket as a result of the additional standard deduction from, say, Social Security, things, the increased child tax credit, things like that. The reality is the next couple of weeks on this program, we're going to be joined by Kristen Costello who is a CPA with us here at Nelson Financial Planning, and then the following week it's Christina Lamb, who's an IRS enrolled agent here at Nelson Financial Planning. We're going to have them on the show in the next couple of weeks to really talk through kind of these tax changes, because guess what? Tax season around the corner, gearing up for that. The other impact on the tax side is that, don't forget the bill had a lot of depreciation benefits or depreciation provisions in there that are going to allow companies to expense things at a much more accelerated rate, which could lead to increased spending. Increased spending, obviously good for the economy. So theme one for 26, AI. Theme two, tax cuts. Theme three, again, a little bit of a continuation of a theme from last year, and that is the Federal Reserve and what it's going to do for cutting rates. Obviously, some of the weakness that you're seeing in the labor market, some of the higher inflation that's impacting the consumers. But there's still a pretty good amount of consumer spending happening. Corporate America is still making pretty good money. So I think it becomes a little bit of a difficult proposition for the Federal Reserve to really cut rates as regularly and aggressively as I think some folks would like. Lower rates, obviously stimulative to the economy, but you don't want to lower them too much too quick, because ultimately that generates other economic issues that can spike inflation. So we think we'll see some Fed rate cuts, but maybe not as many as what is predicted. I would say you could see as few as 2 or 3 Fed rate cuts during the course of the year. I don't think 5 or 6 or some of these other predictions are accurate based on kind of what the landscape looks like. Fourth, the cloud of the tariff uncertainty that sort of overhung the markets last year. I think that continues to dissipate and perhaps remains subdued. I'm sure it will raise its head from time to time, but certainly not have quite the same dramatic impact that it did during the course of 2025. Of course, the real uncertainty on the political side of things is that, let's not forget, 2026 is a midterm election year. That's certainly going to dominate Washington and lead probably to little progress on anything that is substantive. So those are kind of the factors or the trends that we see that could be a little bit more on the positive side to 2026. If we take the flip side and talk about the risks, I think the biggest risk is just the reality of what's happened over the course of the past 3 years. You've had 3 years in a row where the markets have basically generated double-digit growth. And, while we would love a fourth year, I have to sort of temper your expectations on that. The markets don't go up like this all the time on a nice, regular, smooth pattern. So I would say I would be a little concerned about the staying power of double-digit returns for the year 2026. And certainly last year wasn't exactly a smooth year with a nearly 20% decline to start the year, but it led to a very quick recovery. Again, as we said earlier, highlighting the notion of the importance of consistency in 2025. Certainly, by some measures, you could argue that stocks are expensive, and particularly when we think about kind of price relative to earnings, things like that, and that expense concern is also correlated to the concentration issue, whereby overall market concentration is really focused on a very small group of companies that basically are all in the same kind of industry. That concentration among those group of 8 companies is much higher than even in the late 90s. That those 8 companies today drive over 40% of the performance of the S&P 500. So think of it this way, S&P 500 is supposed to be an average of 500 companies, right? But because it's market weighted, the bigger, larger companies will dominate. You've got 8 names basically dominating and generating 40% of the performance in that index. That's pretty narrow. And so here's the thing I think to watch out for in 2026. Because of the narrowness of that, you could certainly see a bit of a sell-off that shows itself well or much more strongly in the market indexes. And so here's where we want to make the distinction between the markets as a whole, measured by benchmarks like the S&P 500, things like that, and a diversified portfolio. Look, as we were saying last year, the key to getting good investment results for the year was to be consistent. We believe that the key to getting in good investment results for the year 2026 is going to be diversification, because if you see any kind of weakness in this group of 8 that's all in AI, that's all in technology, you're going to see major declines in the indexes, or much more significant decline in the indexes than what very well may be happening in the broader market among a broader cross-section of companies. So you could really see where having a diversified portfolio significantly outperforms the overall market indexes. Again, that's the theme for 2026, diversification. Last year was consistency. If you were inconsistent and jumped out in response to a 20% decline in the market that started to start the year, you missed out on the full recovery and then some, and what ultimately created a double-digit return for the markets in the year 2025. We think 2026, it's not going to be the market indexes that lead the way, but rather a much more diversified portfolio that really helps to balance things out as best as possible. So we think that's going to be the big theme. The risks of sticky inflation, labor market, all of that, and midterms, and mounting government debt, all of that is a big part of that. Interestingly, if you're elected as a senator here in the midterms, then your term is going to include the year 2032, which is the year that Social Security is projected to be running a shortfall. So I would expect to see some movement more on these bigger picture issues that have to deal with government debt. And in dealing with that, you may find that that creates a little bit of a drag on the economy, because the money's got to come from somewhere, folks, right? So with that backdrop, if you will, if we think about the positive trends that we expect in the coming year, we balance them out against the negative trends that we think we'll see in 2026. It could be, in a way, a little bit of a pause year for the markets, we think. 3 years in a row of double-digit growth, it becomes hard to do that on a fourth year. And along with the concept that I think diversification is going to be key and crucial to helping investors through generate overall returns for the year. Certainly be a very different story if you're focusing solely on the market. So with that backdrop, We're going to take a break and finish up with our fearless forecast along with some tips to successfully satisfy your New Year's resolutions. Coming up here on Dollars and Cents with Joel Garris of Nelson Financial Planning.